Okay, Fionnuala, will we get going?
Yeah, I think so.
Perfect. Okay, so good afternoon, everybody. You are very welcome to the first workshop in a series of three workshops in this year's edition of the Investor Literacy Program, which is part of the wider UHC's project that we have been running along with 16 other partners over the last 2 years, supporting Ukrainian startups, deep tech startups. So you're very welcome. We have a lot of people joining us from all over Ukraine and all over Europe. You're very welcome this afternoon, and I hope you enjoy the next couple of hours with myself and my colleagues, Georgie and Fionnuala. We're going to be helping out and hosting a different parts of this workshop over the next while, over the next couple of hours here. Um, I my name is Larry. I'm the CEO of an organization called Access BIC. We're an organization based here in Ireland. And we work very closely with high growth startups. And obviously, part of a high growth startup, and very often an important part of being a high growth startup, is attracting venture capital investment and equity investment. And that's something we are very well versed with here in Access BIC. Um, as in terms of the Angel Investor Literacy Program, as I said, it's part of a three-workshop program. It's going to be virtual over the next 3 months. So it's a series of workshops, key presentations. During those workshops, we've got some really interesting panel discussions and experienced angel investors who are going to pop on and talk about their experience with angel investing and syndicate investing in particular. We have a number of very interesting keynote speakers that are going to come on and share their experience. Today's speaker is going to talk to us about investing in deep tech startups specifically. And we're going to see a couple of successful startups actually pitch to show you what an investable and a successful startup actually looks like as they go through their early stage investment raising journey. So overall, the aim here is to support prospective angels, perhaps new angels that are thinking about starting into angel investing, current angels that are just looking to enhance their understanding of angel investment and just to grow the network of angel investors, particularly in Ukraine, to support Ukrainian tech startups. So today's journey, just to look a little bit more detail, I'm going to go through the overall program in a second. So the three different workshops that we're going to conduct over the next 3 months. My colleague Fionnuala is going to pop on soon and talk about the wider Seeds of Bravery program and the why behind the Seeds of Bravery program, of which the Investor Literacy program is part of. My colleague Georgie is going to pop on and talk to us about some of the initial introduction to angel investing and go through some of the terminology and reasons that people become angel investors and talk about some of the risks and rewards associated with angel investing. Our friend Yuri is going to pop on then and talk to us about angel investment ecosystem in Ukraine and give a picture of exactly what that looks like at the moment. And we're going to take a little bit of a break then. So grab a coffee for 5 minutes or so. And after that, we have a very interesting panel discussion put together of four very experienced angel investors. And we're going to talk to them about their journey to angel investing and just get some of their expertise and advice. And then finally, as I mentioned, we're going to hear a keynote on the area of investing in deep tech startups. Okay, so in terms of the three workshops we're going to go through, today's workshop, as I've explained, is an introduction to business angel investing. The next workshop on October 23rd, we're going to start to talk about angel syndicates, when groups of people come together to invest as a group in a startup. We're going to talk about those syndicates and how they become networks within countries. So groups of a whole network of angel investment in countries. We're going to talk about the European angel network across Europe and how that is connected and invests in startups across Europe. And then on the 27th of November, we're going to move on to talk about how investment is actually made into these startups. how due diligence works, how a number of investments begin to form what's called a portfolio, and what's involved in managing that portfolio and in managing those companies towards exits, and talk about some of the successes that angel investors have had through investing in early stage startups. So that's the journey we're going to pop through, from an initial introduction today to angel investing, all the way through to investing in startups and exiting from them. So I think we're covering a good breadth of different subjects there. And so one of the nice takeaways from this, everyone who participates in all three of these workshops will get a certificate of completion that certifies you as an angel investor, and that's certified by the Seeds of Bravery project itself. So I think that's a nice takeaway. If you want to pop that up onto your LinkedIn page or just have it as part of your CV, you will be a certified angel investor having gone through this program. So that's a nice takeaway to have. Okay, so thankfully you don't have to look at my face for all of this workshop today. I've got some lovely colleagues that are going to help. And you see Georgie and Fanula on the screen there as well. So Georgie, do you want to say a quick hello?
Hello, everybody. Nice to meet you. Hope you enjoy the program. I'll be jumping on a little bit later on.
Perfect, Georgie. Thank you. And Fanula?
Hi, everybody. Good to meet you. I'm the EU projects coordinator for Access BIC within Seeds of Bravery, so I manage our involvement in the project. So lovely to be here today to discuss all things angel investing.
Perfect. And we're going to hear a little bit more from Fanula soon. So I guess just to establish some of our Access BIC's bona fides in terms of angel investing, we're very much involved over the last couple of decades, over the last 20 years or so in Ireland, in terms of establishing what is known as the Halo Business Angel Network in Ireland. So in 2007, we were part of a consortium of 4 organizations that established that network of angel investors. Prior to that, there wouldn't have been any formal network of angel investors in Ireland, and no structured angel investment. So over the space of 17 years, we grew that network in Ireland to 13 different independent angel syndicates that each had their own areas of interest in terms of investing. There was over 700 angels, registered angels in that network, and the amount of investment grew from effectively zero in 2007 until we had over 33 million of angel investment annually in 2023. So that angel network continues to be an important part of the early stage investment sources within Ireland. So we've had a lot of involvement and hopefully a good deal of experience that we'll be able to show with you throughout the 3 workshops on this investor literacy program. A really important part of today as well is your involvement, and we would encourage this. This is a webinar, but we want this to be interactive. So we want you to, if there are things that aren't making sense on the way through, if you have any questions that you want to ask on the way through, use the Q&A function. We can see those questions coming in. We can bring them to the panel sessions we can bring them into the keynotes. But it's important that if there is anything occurring to you, then do please ask the question and pop it in, and we'll do our best to take care of that question. Okay, so perfect. I'm just going to hand you over to Fanula here, and Fanula is going to talk a bit more about the wider program, which is called Seeds of Bravery. This investor literacy program is one part of that. And there's a lot that has been happening over the last couple of years in that program. So Fanula, I'll just hand over to yourself and you can give a bit more information there, please.
Thanks, Larry. Lovely to connect with you all today and delighted to see so many people joining our webinar. Seeds of Bravery, many of you will already be aware, is a 20 million euro project that is funded by the EU under the European Innovation Council. If you can go to the next slide there, Larry, please. And it is to support Ukrainian tech startups, bringing them closer to the EU. Next slide. In this consortium, there are 17 partners and 2 associated partners who span right across Europe and Ukraine and have been working together since December 2023 to work with startups in many different areas. Next slide, please. Of the 20 million euro that has been allocated to this project, 12 million of that is going to go to the beneficiaries of this project. To date, we have selected all our beneficiaries, which is just shy of 300. Up to May 2025, 117 startups had been awarded just under 4 million euro from funding of Seeds of Bravery Consortium. Investing in such groundbreaking projects drives economic growth, generates employment opportunities, enhances overall quality of life. Seeds of Bravery remains committed to strengthening the Ukrainian startup ecosystem by empowering entrepreneurs to bring their ideas to life and expand into global markets. These are the programs under which each of the beneficiaries would have applied. Next slide, please. In addition to the financial grants, Seeds of Bravery is so much more. It offers startups participation in non-financial support programs designed to strengthen their market position. These include business consulting, intellectual property and patent analysis, market analysis and validation, internationalization services, portfolio management and investor relations, matchmaking with investors, crowdfunding campaign planning. The Seeds of Bravery program continues to create opportunities for startups, providing financial support and fostering their integration into the global innovation system. This initiative not only helps small and medium-sized enterprises secure funding, but also equips them with valuable knowledge, connections, and tools for scaling their businesses both in the EU and globally. I think that's my bit done.
Perfect, Fionnuala. Thank you very much for that. So yeah, just hopefully that gives you an idea of the wider program of which this investor literacy program is part of. We really love being part of it. It's been hugely rewarding and important program for us, and we look forward to the rest of the program over the next 6 to 9 months. Okay, perfect. So my colleague Georgie is going to pop on now. I'm just going to finish sharing here, Georgie, so you can pop up and control your own slides there. So welcome, Georgie. I'll hand over to yourself.
Thank you very much. Just bear with me one moment, and they are not the right slides. So, okay. Great. Can you guys see those slides?
Looks good, Georgie.
Perfect. Okay. Great. Thanks so much for the intro, Fionnuala. And I suppose just to give a little wider introduction on myself, I'm the head of programs here in Access BIC. So I look after all the programs that we deliver through our nationwide investment provider, Enterprise Ireland, along with other programs that we deliver out for entrepreneurs. And I've been working specifically in the area of entrepreneurship development for the last decade. So delighted to be here with you today. And hopefully there'll be some information that will be relevant to the next steps of your journey in the investment world. So going to give a few examples of what angels do beyond just giving money and how that happens. So usually a business angel is somebody who invests their own money in early stage companies. And that exchange is for equity, because those early stage companies are often pre-revenue. So in contrast with what a VC might do, an angel invests earlier with smaller tickets and is, generally speaking, personally motivated to take part in that journey. So these are some of the areas that might happen in. So there's a lot of terms around investment, and if you're new to the investment world, we've developed a glossary of terms that will be sent out to you afterwards. And some of those things that you might hear could be something like a deal flow. So a deal flow is how many opportunities you might see. So if you only see maybe 2 deals a year, that wouldn't be a very active or strong portfolio. The deal lead or lead investor is the person who negotiates and coordinates, and not everybody involved needs to be a lead. So that would depend on your own requirements and maybe experience. Something that is often used is the term an exit. So an exit is when you get your money back, and if you get your money back, and hopefully that money might have multiplied through your journey as an angel. So there's a lot of different terms. And another term that is often used is unicorn. And a unicorn, the reason behind the term is that they're not often seen. So a company that's a unicorn might be 1 in 10 companies, or to look at it the other way around, 9 out of 10 of your investments may not have multiples of return for you. So everybody is in the investment world searching for these unicorns that might appear. And as an angel investor, I suppose what's important to remember is that you shouldn't or couldn't expect every single investment that you make to be a unicorn. And knowing that as you build your portfolio, that only maybe 1 in 10 might become that. So you could think of companies perhaps like Airbnb would be a well-known unicorn. There might be Uber or Stripe. But the principle is the same. They're rare and they're a little bit extraordinary. There's something different coming along with those companies that are going to transform your portfolio. So the term, the definition of an angel investor is a high net worth individual who makes personal investments in startups. And that's typically seen at an early stage, and that's often before there's any revenue in the business. So they earlier than many VCs would invest. So then we will look at the ticket sizes, what kind of money you might be thinking of investing. So if you are thinking of investing your money, it's generally going to be between €10,000 at a minimum, and then upwards to about $250,000. You can invest more than that, but that would generally be, and we'll look at the series of that a little later on. So you're investing, because these companies are pre-revenue, you're investing equity. And the reason you're doing that is generally motivated by wanting a return on your investment. Now that return might be something between 5 times and 10 times what you've put in the beginning. With angel investing, if you decide 6 months later that you want your money back from that early stage startup, you can't have it. You would need to wait until the company is ready for you to exit. And that could typically be from between 4 years and 7 years. Sometimes it happens quicker. The stories we hear about are often quicker, but in the reality, it would be a slightly longer tenure, something like 4 to 7 years. So why become an angel investor? And I'd be really interested in actually putting that question to you. So some of you here may already be angel investors. You might be thinking about it. You might be in that world. I'd love to hear in the chat, why would you become an angel investor? So if everybody can pop in a short comment and let us know, why does it appeal to you? And we can have a look at that. I can't see the chat on my screen, but maybe Larry or Fanula are able to access that.
There's nothing on the chat at the moment, Georgie.
Okay. Perfect. Okay, great stuff. So if you're here on the call and you're thinking about it, I'd love to know the real data behind it. We do have some reasons why people would become an angel investor, but do let us know why you're thinking of becoming an angel investor. The benefits are that you will get a high return, but there's also the rewards in terms of maybe you're doing something for the local infrastructure that is of interest to you. I think I've seen something popping up and now it's gone. So there's a 90% risk that it's going to fail, even later in there it is. Sorry, now I have it. Chat is disabled. Q&A is working. Chat is disabled. Okay, apologies for that. Okay, we might be able to rectify that on our end here. So see what we can do. So early stage valuations. So companies that are high potential startups typically would have a valuation between 1 and 10 million. And then with that, so that's a reward, is that you're going to get more than your money back, and you will potentially exit with multiples of your valuation that you put in. Now, to give us some real world examples of that, we've looked at a couple of companies that have had early stage angel investment, and my colleague Larry is going to walk us through these companies. He has some first-hand experience in dealing with them. So I'll let you jump in there, Larry.
Cheers, Georgie. Thanks very much. So yeah, look, obviously these are some of the kind of good stories that come out of angel investing, and two of them, Glowfox and Eventimed, are Irish examples. We operate in the kind of Irish landscape, so these are ones that are familiar with us. Voodle is a Ukrainian example. I think a lot of our Ukrainian friends might be familiar with this one. But just starting with a Glowfox, this was a fitness tech company that started in 2014. The exit then was in 2022. So we're looking at an 8 year from founding the company to an exit. That's relatively long in the scheme of things. 4 to 7 might be a little bit more typical. But I think with this example, it was worth the wait in the end, because investors got a 200 million exit on this company, and that would have been angel backed initially. It went on to be VC backed after that, but it returned a very nice return for the angel investors that were in this in Glowfox from the start. The second, Eventimed, was an interesting company local to us. It was a client company of ours in Access BIC. It was a medical device, so a health tech medical device startup. It was a medical device that allowed grommets, so ear grommets, to be inserted in a child's ear without needing that child to be put under general anesthetic. So it brought a huge change to that whole procedure. It brought a lot of the stress out of that procedure for parents and for children in particular. And the interesting thing about Eventimed, it's very typical that medical device companies have quite a demand for investment upfront. So it's a deep tech investment. They can be quite hungry for cash well before they start to generate any revenues. So and therefore are very often venture capital backed and not necessarily associated with angel investment. But this one was interesting. It was angel backed all the ways. So it never took on any venture capital funding at any stage. It took on, I think, about between 7 and 8 million of angel investment through its lifetime. It exited in 2023. It started in 2015. So it was 8 years from start to finish there, which would be fairly typical for medical device. The amount that they exited for wasn't disclosed, but what I can tell you is the angel investors that did invest got between an 8 and 10x. In fact, some got a 12 times return on their investment, which again would be a relatively good story for the angels that got involved there. So Voodle, this Ukrainian startup that would be very well known in the Ukrainian context. I think a lot of people might actually use this technology kind of unbeknownst to themselves. It is the facial recognition technology that sits behind all of Google's Android technology. So if you're using a Google Android phone, it's Voodle's technology has enabled that. It's a while ago now. The exit year was in 2012. And I don't have the exact figures, but somewhere between 30 million and 45 million was the exit value that was got there. So just look, an example of when the exits do happen, what you are looking for. It is It is a high risk type of investment, therefore you do expect a high return on the ones that do work out. And there are lots of examples of investments that do work out as well. Cheers, Georgia.
Great stuff. Thanks so much, Larry. Perfect. So there are lots of good news stories, and equally so to be aware that not all of them work out like this. So having that in mind. So this high failure rate, it's a failure rate of startups, not of investments, really. So the statistics show that about 90% of startups fail. There's lots of different variables included in that. So we're going to look at maybe some of those reasons from very recent data about why the startups themselves fail. And as an investor, it's really important to be aware of these factors when you're weighing up, is this a product or service or company that I'm interested in investing in? So the number one reason, or the highest percentage across the board of failure rate, is due to lack of product market fit. It's 34%. So 34% is quite high. And if you think of it as nobody starts a business going out there thinking there isn't a market, but you need to press into the proof that there is a market in place. Of course, every founder believes there's a market when they set up on day one, yet 34% are failing due to no market, or the market not being ready, the timing not being there, the product not being the right fit for the market. So then the second highest reason for failure is the go-to-market strategy. I find it really interesting. So 50% are variables of what the market is saying about the product. And again, no founder thinks they don't have a strategy when they're setting up. No founder thinks they're going to fail due to strategy. If you skip down a little bit, you'll see finance problems are about 16% of the failure rate. And again, most startups think that it's just money that they need. If I had money, this could be a success. So before you go about investing your money, having a look at the business with these areas in mind, the team, is there enough of a balance of skills shared among the team? The tech is only 6% of the reason that startups might fail. Operational problems and legal problems, again, low down, but we hear about these in the news very often as these being the reasons. So looking at your diversification of what you might be investing in based on some of these factors could be a way to help you decide what companies that you go for. If you've got good proof that there is product market fit and the timing is good, that might be a very good reason. And then the higher the risk, the higher the reward very often. So balancing those depending on your appetite for risk. So the levels of engagement in angel investing is something that people often wonder about. What do I need to do? Is it just my money, or what more do people want? And that is very much up to you as an angel to decide with the company that you're investing in. You can be passive, just giving your money, taking a back seat, maybe not checking in very often, and or you might be active. So you might be doing some mentoring occasionally, checking in, getting some investor reports back quarterly, maybe from the company. So you're just keeping an eye. Or you might be very active. And a very active angel investor might have a role on the board. They may be quite hands-on. And this is a kind of a moment where I'd say to you to have a think about that. Where would you like your level of involvement to be? And maybe if you're thinking of having a portfolio of investments, perhaps there'll be some businesses that you'll want to be very active in and others that you'll be more passive, depending on what the product is. So beyond capital, there's a few things that I've already mentioned, like mentorship, your network, your credibility. These are things that you can invest alongside your money into these companies, and often an introduction to somebody could be far more valuable than the money itself, an introduction to a potential partner or customer. Your industry expertise, a non-executive position that you might have or take, impact in the community. So you might want to invest in this company to create jobs in the Ukraine, and you might be doing it for that reason. It might be a sense of community. It might be the innovation in the product, that this is something really vital that is much needed, and you want this company to grow. So your contacts, your motivation, your time is extremely important to certain companies, depending, and this is always on a case by case basis, depending on where you're choosing to invest. So the start of funding progression, there's a lot of these terms again, and these will be contained in the glossary. So these are things that a startup from bootstrapping. So bootstrapping, very much putting their own money into a company, a founder investing their own savings into it. That's the bootstrapping side. That's the explanation that's necessary in, I would say, most startups. That concept, that ideation stage is backed by the founders. Then this pre-seed validation is the next area where angels might start to get involved. They might not, but they might start here. This is kind of where friends, family, there might be some government grants, there might be funding like the Seeds of Bravery project provides to some early stage founders, and there might be some angels that get involved here. And this, as you see across the bottom line, the blue line, until it kind of starts to turn green, and it could start anywhere. Validation, so this pre-seed, the seed stage, Series A, angels would stay involved, and it's usually around here as a company continues to scale and grow that there might be an exit of the angels. They could stay involved up to Series B and Series C. So you're bridging that gap until the company gets bigger and they take on different types of investment. And that is the end of my section. So if you have any questions, I don't know that the chat have them. And Larry, we did get a question in there that you might be able to help with. So
Okay.
Ruslana has asked, what about CVC funds? So that's not something is CVC? Is that something that you're aware of?
CVC funds.
Yeah.
As in, well, VC, I'm very familiar with, so venture capital funds. CVC, unless it's a typo, then it's corporate venture capital. Okay.
Okay. Yeah.
Yeah. So look at it's absolutely it's a form of venture capital. They absolutely exist. Lots of companies will put funds alongside their own company and invest in specific areas of innovation that they are interested in investing in. I know, for instance, the likes of SAP would have invested in funds that then invest in accelerator funds run by formal accelerator programs, and they invite companies that are developing technologies in those areas of interest, and they might invest 100 grand or 200 grand into those companies at an early stage with some capacity to follow on invest after that. So yeah, absolutely, it is something that it's an important part of the equity funding landscape. They operate the same as any venture capital fund would operate. They take equity investment, but I guess the advantage of these is you'll often be developing something that they are interested in, customer or a partner to bring that technology to market. I think typically it's going to be a later stage investment. So venture capital, most often kind of arrives on after bootstrapping investment and after angel investment comes on. So it is something that that would be typical for later stage investment as opposed to kind of early stage, and we're kind of very focused here today on kind of angel investment or formal angel investment, and venture capital would tend to come along at the next stage after angel investment.
Perfect.
So do they also exist? Absolutely, yeah. Yeah, CVCs exist. You know, we know of a number of these. I think in our next workshop, we're going to talk about the Pan-European Angel Network. I know that that'll be discussed as well as part of it. So yeah, we might ask one of our, if Jerome is on the call there. I know he may have a bit more to add around corporate venture capital. Any past experience yourself, Jerome, on that side of things?
So on our side, we've worked a little bit with HubSpot's CVC. It's important to understand for the people who are seeking funding from CVCs that what their strategy is, why they are actively investing in companies. Many of them will do it because they are looking for their potential future acquisition, right? So they or they are looking to improve the ecosystem that they invest in. So in the case of a HubSpot, they will very often invest in early stage integrations and potential related companies where they might be seeking like an acqui-hire or something like that. That's the extent of my experience.
Yeah, okay, that's interesting. Yeah, perfect. Okay.
There's a couple
Okay,
more
so
questions there, Larry.
yeah, I see those popping in there. So Ruslan, and thanks very much for the questions, folks. We'll see if we can answer some of these. Could you please share information about family offices? What is the specific of this type of investor? So yeah, look, it depends. Family offices kind of vary across kind of stages of interest. They very often the angel syndicates that we run, they form part of an investment for a startup. The family office may form part of that co-investment alongside. So, typically family offices, they kind of vary, but they tend to be kind of early stage and may span into kind of Series A stage investment then as well. It's, for all purposes, it looks like an angel investment. Some of these family offices are very professionally run, and they might look like a small VC as opposed to an angel investor. So it depends on the kind of stage of maturity of the family office and how big it is. But yeah, we work at they're an important part of the investment landscape for sure. Active at early stage being seed, pre-seed, seed, and maybe Series A. So yeah, absolutely an important part of it, but can vary hugely. Family offices managing the net worth of wealthy families and investing in specific areas of interest. But it's an important, for sure, an important part of the of funding as well. There's another question there. Any venture funds I can join with smaller tickets around 5 to 10K? That's actually a question we might hold, Georgie, for the panel session, because we've got some angel investors who've gone on to run VC funds. So we can talk about small ticket sizes. 5 to 10K would be a very typical angel investment size. So it might be more associated with kind of angel investment for sure. But we can talk about the VC opportunity there.
Great.
So yeah, perfect.
There's one more there. How accurately?
Okay, sorry.
Do you see that last one there, Larry, as well?
Oh yeah, okay. How accurately evaluate a project at the pre-seed stage when there's no income yet and the project is still searching for product market fit? And what share request in a startup? Is there a market benchmark? That's a big question. So a big question. Absolutely. Look, it's difficult pre-seed and even at seed stage, often pre-revenue at seed stage as well. when there isn't revenue, it's very difficult to put a valuation on a company. But that doesn't mean that you can't raise investment, right? It just means it makes it more difficult to put that valuation on. In that case, what we see a lot at the angel stage is they kind of avoid the question of valuation, and they might invest through what's called a convertible loan note or a safe note or something that just kicks the whole question of valuation down the road a little bit. So it says, okay, look, we just don't have the metrics here to put a proper valuation on the company. So let's put some investment into the company. Let's put it in with certain criteria around it, like a convertible loan note. And when you raise at the next round and you've got some more metrics to put a valuation on the company, then let's invest or let's convert to equity at that stage. So we use a mechanism called convertible loan notes or safe notes to kick that whole valuation question down the road a little bit. So it's I'm not avoiding the question, but it's just it's just a difficult it's a difficult thing to do at pre-seed stage. But it also comes back to, you don't want to give away. You've got to be really protective of your equity at the early stage. You know, in angel investment, we see usually not less than 10%, but ideally not more than 20% of the company being given away at seed stage. That might give you a little bit of an idea of what kind of values are being put on companies. But yeah, what we find is it's usually not the big thing. Valuation is not the big thing that companies often think it is. It's not the main reason that an investor does or does not invest. There's a lot of other kind of key pieces of information are actually more important than valuation when it comes to it. Sarah, I'll hand the floor over to yourself.
Great. Can you see the screen being shared?
Yeah, that's perfect. You can see it there. Yeah.
Excellent. Fantastic. So basically, what I'm going to cover is my day today. I am a venture builder, so I have a team of people bringing technologies from lab to market, technologies that emanate from Tecnalia, that I'm going to get into just a moment to describe what it is. But it's a research organization. And basically, I'm quite connected to a European ecosystem of deep tech. I am an active part of the European Innovation Council. I'm a jury member. I am a part of something that is called TTO Circle. It's like a G35 of tech transfer offices in Europe, where there are the likes of Fraunhofer, Commissariat à l'Énergie Atomique, VTT, TNO, CNRS, so on and so forth. And basically, I've been throughout my career working and living in many different countries, including Ireland. Actually, Accenture is the place where I was, but very connected to innovation and startups. So Tecnalia is the largest applied research organization in Spain, probably in Southern Europe, private research organization. So like 1,000, almost 400 researchers out of the 1,600 people that are part of this organization that are trying to develop exciting breakthrough innovation. The mission of the company is to transform technology into prosperity. In the past, it was to transform technology into GDP. And we expanded the definition of impact by bringing into the picture elements other than just the ones related to economics. And what I love is moving after this slide into this slide that is actually where Tecnalia Ventures comes into place. This picture is not generated by artificial intelligence. This is one of our portfolio companies that is portrayed in Times Square, not yet in the context of an IPO, but basically it's because this company is being chosen as one of the top 100 companies worldwide in order to address some of the most difficult societal problems. And this is a company in the realm of decarbonization, basically uses highly innovative palladium membranes to filter hydrogen out of molecules such as ammonia, and this could facilitate or address the problem of transporting green hydrogen by importing actually ammonia that is currently routed into Europe and cracking it into hydrogen. So this is a highly successful company where we already had a secondary, and is in deep tech. Oftentimes, people believe that it's complicated to make returns. So we already had a partial secondary 2 years following the incorporation of the company, and with the last B series of 36 million euros that we closed later on last year, we have a multiple of almost 35 on the pre-money valuation. And obviously, it's exciting also the type of impact that it delivers. The headlines are in Spanish, but this gentleman, the CEO, is saying that 200 people are going to be incorporated into the company in the next 3 years. This is industrial-based company, so high-quality employment, plenty of PhDs, and obviously quite aligned with creating impact in terms of reindustrialization of regions in Europe. We have other case studies. Top left actually is H2Z. It was the first investment by Breakthrough Energy Ventures, Bill Gates fund from the US in Europe. We have the King of Spain granting an award to a medical device company of ours. We are also in the taxi drone space, quite challenging over the last months. And also quite challenging also the offshore floating platforms. And the common denominator of all those spin-offs are breakthrough technologies developed in Tecnalia. So those are some of the metrics in terms of what we've achieved over the last, let's say, 12 years, 23 spin-offs, evaluation of excess of 300 million euros, more than 225 million euros of funding obtained for our portfolio companies, plenty of high-quality jobs created, revenues for the company, and the ability to generate new supply chains, because behind each of those companies, you have innovative products that require innovative manufacturing facilities, and this creates the opportunity for some SMEs around the region to reindustrialize or to diversify into higher value-added segments of the market. Well, I'm not going to get into a detail, but basically, as you can see, we cover all the way from health to digital transformation, decarbonization, sustainable mobility. So that's the realms of activity where the researchers internally are focused on. As I mentioned before, we're also part of the TTO Circle. I'm on the board responsible for deep tech entrepreneurship. And the common goal that we all have in the TTO Circle is just to address these couple of figures that we have here. So Europe is consistently strong in terms of production of scientific research, top technologies, or very promising technologies, but we are consistently bad in terms of ultimate impact of those technologies in the market. So when we talk about deep tech, I think it's worth just showing this slide of deal room. So we are talking about twofold companies that are characterized for a twofold risk in terms of R&D or more broadly speaking, technological risk and market risk. And basically, we are talking about a pioneer market, a market of pioneers, where we are basically trying to foster innovative products that are based on some scientific discovery and or some engineering applied to those discoveries covered by IP. And the issue that we have is that the initial sales are not product sales, but are prototype or demonstrator type of sales, because you have all the issues of early adopters being quite reluctant to use those products until you have enough running hours in a relevant context like industrial context, and quite complicated to move into mass market. 10 times people lump into the same category biotech, but there is a twofold difference. In biotech, you have a very high technological risk, but if you get it right, you can scale quite fast. If we remember about the pandemics, and BioNTech, a startup that was associated with Pfizer, plenty of uncertainty in terms of this ARN messenger solution on the vaccines. But once you get all the regulatory approval, the issue is simply to be able to produce as much as it is needed. And therefore, there is no market risk as such. It scales quite fast. And secondly, you don't need to create from scratch the manufacturing facilities to mass produce this type of drugs. They already exist. In the case of deep tech, you have to come up with the machines that are going to create the innovative products, and this always brings plenty of CapEx requirements into the picture. So that's what I mentioned. So pioneers course, plenty of regulatory risk as well. With the taxi drone is quite clear, but with any of the examples that I have put forward, regulatory is a real pain in the neck. Plenty of involvement from public sector to the risk, the perception of investors by fostering the use of demonstrators until the actual product is quite well defined. Quite sensitive also IP, a robust IP, and very important to look into industrialization roadmaps and the manufacturing, or these innovative manufacturing facilities, how are going to be funded. I'm not going to get into the detail, but a very interesting piece of exercise in terms of defining deep tech in a very exhaustive manner is report by MIT, What is Deep Tech, from 2022. I have no problems just sharing the slides, and you could find the link there, but we can see that it's very CapEx intensive for R&D. You need to be connected in an ecosystem with labs that can produce this breakthrough type of technology, and technologies that oftentimes can have many different applications. All right. So a strong focus by European Commission in this topic for a twofold reason. Technological sovereignty, obviously, are vectors of development of technological sovereignty, and the potential of deep tech to reindustrialize regions in Spain. In the case of H2SI, for instance, we have 130 suppliers of that. Most of them are around 100 kilometers around the company, and before they were in value chains that were not as exciting as hydrogen. Very important in B2B to resolve a P&L problem, and some takeaways from my experience. Basically, my role, or the role of my team, is to connect what I call the 3 M's, minds, management, and money. That is what makes up the deep tech ecosystem. You have you need to identify technological excellence emanating from some lab in a university of research organization. An important part of our role is to focus this technology on resolving P&L problems for which someone is going to be willing to pay, because most of the deep tech, or almost all the deep tech, is B2B in terms of business model. And you've got to resolve a P&L problem, or large P&L problem, to people. Then it's very important to create well-rounded teams with people in the lab, but people also with business acumen. And this is an important part of our role to set up the right incentive system, the right cap table, and then look for a smart capital to cross this valley of death. The way I see actually our role is using the analogy of a football team is like midfielders. To me, the ecosystem widely in Europe looks a little bit like if you have defenders that control the ball. To me, the analogy is you have plenty of programs that are financing the development of breakthrough technologies. And on the other side, there is plenty of investment in terms of VCs, but VCs require companies to invest in, right? So who is responsible to transform breakthrough technologies into investable companies for the strikers? And that's basically the way I see it. And you need, like in a midfield in football, a different type of profiles that can connect with the defenders, profiles that can pass the ball in optimal conditions to the strikers. So people in the team that are specialized in funding, people in the team that are specialized in analyzing IP, the technology, competitive landscape, so on and so forth. But also people who are going to create those teams with the right entrepreneurial spirit and with the right incentive scheme. And finally, very important from the onset is the governance, is to focus on having a good governance with a strong focus on a go-to-market strategy, product channel, clients fit, and just having good board dynamics with a chairperson that undertakes that role and try to prevent conflict of interest. At the end of the day, if we look at deep tech from the perspective of an investor, we will be looking for large and growing markets where the opportunity could be positioned. We'll be looking into technological feasibility and profitability, hence resolving a P&L problem, sustainable competitive advantage in terms of IP, and obviously, of paramount importance, the team, a well-rounded team capable of executing. So hence, we have here those two gentlemen that are a very good example of CEO and CTO. We need a lot of focus because, again, technologies could have different business models, could land into different type of products. You could get tangled with developing a service type of business model that perhaps doesn't scale as much, or engineering as a product-based business model. Very important to be focus extremely on client segmentation, what is actually the product or products that we have, and channel strategy. Was mentioned before about valuation. So definitely valuation shouldn't get on the way. There is no science here. I mean, you can use comparables, but it's very hard to find comparable comparables because they have to be comparables in terms of geography, sector, market traction, so on and so forth. So safe is a good way to go, but you could also try to articulate warrants. So if you don't agree on the valuation in T0 and you agree on a future valuation contingent on some value creation milestones, that could be a way to go and articulate it with warrants, or just ratchets in terms of at some point in time, contingent on the exit that an investor had. You could say that everything that goes in excess of IRR of 25% starts getting share, or so on and so forth. So important to become imaginative. And finally, I think that in Europe it's very important that we dream big, that we get ambitious with this type of challenging entrepreneurial startups, and perhaps we don't realize that what we believe it was impossible finally was possible. So thank you very much.
Excellent, Aster. It was really interesting, and you introduced lots of kind of concepts there, like ratchets and milestones and etc. But what's really interesting is the whole concept. I like your, and being from Spain, the football analogy
I didn't talk about the specific players. I could have spoken about
yeah.
Lamine Yamal and about, but I didn't want to get tangled into any sort of discussion.
Yeah,
You know,
but
having
that's
Champions League just at the moment.
yeah, but that is the key thing, and we see this all the time here with university R&D projects, deep tech projects spinning out, and the researchers want to stay with university and retain ownership, and they don't want to spin out, but the
Yeah,
university
very
is forcing to
important
spin out. Yeah,
aligning
but
incentives. So
yeah,
it's
but
very important that if researchers play a critical role in the future success of the company, what we force is for them to leave Tecnalia and
mhm.
have equity in the company. But very important is to align incentives.
Yeah, yeah. So that's for me is the key is this management team that you're talking about. And do you guys help the companies put that management team into place to commercialize the R&D, because that is very
Yeah,
that's the kind of key component, you know?
Yeah, absolutely. Our role, we are the sort of midfielders. So one of the key areas where we focus is to, out of that technology, to see this technology in what product that resolves what P&L problem could evolve into, to
Mm-hmm.
identify the different types of technological risks that we can encounter and how we can mitigate them. But then
Mm-hmm.
we work on the team and try to identify particularly the type of Steve Jobs profiles that are not in the lab. So they
Mm-hmm.
are in the entrepreneurial ecosystems, and you need to look for them. You need to try to team up with the people who are going to be going to move from the lab into the spin-off to create the right incentive scheme. Very important to understand that I often say that equity doesn't fall from the tree. So at the end of the day, equity is generated by sweat equity, is generated by investing money in the company, is generated by some ideation. But if someone is coming just into the game as a potential CEO and is not putting any relevant money and is not willing to activate any sweat equity scheme and has just arrived into the picture, then you have to manage with employee stock options, but probably the presence on the cap table, at least initially, is not going to be significant, and you need to manage all those elements, because otherwise you would alienate people who have been working in the lab for many years and are willing to move into the spin-off.
Perfect, perfect. Okay, Aster, look, thank you so much for jumping on and for coming in ahead of your time,
No
especially.
problem. Okay, take care.
Okay, thank you,
Thanks.
thank you. We'll see
Bye.
you again
Bye now.
soon. Okay, perfect. Okay, so folks, yeah, so look, we've just scheduled in a little break for now, so just for 5 minutes, a little comfort break, and after the break, we're going to come straight back and we're going to have a panel discussion with some of our experienced angel investors. So we're going to have an interesting chat with them. So see you back here in 5 minutes. Jump on to our panel discussion here. So we've got some experienced angel investors we're going to have a little bit of a chat with now. So we've Jerome Leclanche is a serial founder, which is always an interesting one to chat with. So someone who's come through the journey of a founder and has gone on to become an angel investor and run a seed and venture capital firm then as well. Dennis Sharouk is an angel investor and also an experienced investment banker, so understands the world of finance at a very deep level. And our own Teresa Chambers is an Irish angel investor. Teresa is a partner at her own executive search firm, and she is a long history in angel investment here in Ireland as well. So I'm going to stop sharing my screen here and just welcome everybody. But I might actually ask everyone to do there. Maybe Dennis, you might kick off and just give a quick introduction to yourself and your background in terms of angel investing.
Yes, hello, nice to meet you, and thank you for inviting. I'm angel investing since 2020. My portfolio is 15 companies now and growing, and one exit and more coming, I hope, quite soon. overall, my background is from finance. I have background in financial industry for 20 years now, more than 20 years, and also expanding my experience across different sectors. So I'm happy to share my views and my insights from
Perfect.
what I have encountered. Yes, thank you.
Yeah, perfect. Okay, great stuff. So Teresa, you're unmuted there, so I might just ask you to give a quick intro to yourself.
Okay, thanks, Larry. Hi to everybody. Good afternoon. Good to meet you today. So Teresa Chambers, I'm here in Cork in Ireland. I'm an angel investor for about the past 10 years, basically supporting startups and scale-up companies. I also have an executive search business identifying and appointing senior leaders for C-suite, and particularly in that scale-up space. So as company are moving into scale-up, I enjoy connecting people and opportunities, and that's probably where my strength is, really, in bringing together businesses, bringing together people, so through the network. Angel investing, it's really across a wide range of sectors, so med tech, AI, tech investing in pre-seed and seed rounds. So that's a quick intro there.
Great stuff, Lisa. We might delve in a bit deeper into some of those investments as well soon. And Jerome, our founder turned investor, you might just maybe give us a little bit of an idea of the founder journey that you came from and kind of onwards now to angel investing and VC investing.
Thank you, Larry. So I'm Jerome. I'm a serial founder, as Larry mentioned, serial entrepreneur since I was 22. So it's been 12 years, although I have much more than that of a background in tech, in software especially. I started investing in startups now 7 years ago, 8 years ago, actually. The journey from there was primarily small tickets, then following on the actual investments, sometimes getting highly involved, sometimes remaining fairly passive. And for the past 3 years, I've been very active in the Ukrainian ecosystem with 7 Seed and 7 Capital now, investing in that ecosystem, as well as on the side managing my own venture studio. So I'm also a venture builder because I'm still a founder at heart.
Very good, very good. And maybe just a bit more, Jerome, I might stay with you on that. What were the kind of companies as a serial founder? What kind of sectors were you involved in? What kind of companies were you building?
From the beginning, I was in so reverse engineering, cybersecurity, and then machine learning, artificial intelligence. Did quite a bit in fintech as well, and as of recently, also went back to artificial intelligence, which is seeing a massive resurgence. And for the past 3 years, with increased activity in Ukraine, I've gotten very involved in defense.
Good stuff. Okay, perfect. So given that this is the first workshop in this investor literacy program, Dennis, I just want to maybe chat to you a little bit about why you got involved in angel investing, just so that the audience that's online here is made up predominantly of potential angel investors that may be thinking about getting involved in angel investing. So why did you step into that? So leave the world of investment banking, or do that in parallel with your investment banking interests?
Yes, initially I started to invest as alongside my investment banking activity, and the reason was maybe because I just couldn't leave this idea behind. So I started to look at startups, to angel investment opportunities, maybe in 2012, like eight years before I made my first investment. And I just couldn't, unthink about it. And at some point, I just understood that I need to start to invest because it was like natural. I'm ready to invest, and I'm interested to invest, and I want to be involved into this challenging but very interesting area and made my first investment. And now this investment, by the way, was a AI company and in medtech, and they're now based in Netherlands and growing very well, and help people for free detect skin cancer if they might have one from their mobile phone. But overall, yeah, it's the beginning was very successful. My third investment was an exit, so I started to invest more and more, and so here I am with kind of quite a sizable portfolio. But I keep looking at companies. I keep expanding my network, and I'm enjoying it. And you know, when you do this activity, you feel like in present, like you live in the past, because you're looking all around you, and you see that this industry will change this way. This kind of activity will be done different in 2-3 years, and so on and so forth. So you feel like you are traveling in time, you know. So this is also very important for me. And overall, yeah, it's good to know interesting people to help them succeed and also become successful together with them.
Very good. And just to, again, we talked a little bit, well, a lot about angel investing, individual angel investing, and then moving into groups or syndicates and investing with other people. Are you an individual angel investor, or do you invest alongside other angel investors?
I invest in syndicates, and I'm a member of many investor like angels group across, mostly across Central and Eastern Europe. And I'm expanding my network, and my focus is on immigrant founders, on the founders who moved to Europe and US to expand their startups, the ideas in global scale. And yeah, I'm just working to expand my network and to be around when, you know, next interesting opportunity emerges, and you know, to be at least to see it, not if I'm not even able to invest, at least to see what's going on and where the market is moving.
Absolutely. Okay, Dennis, thanks for that. So Teresa, I guess I better kind of full disclosure here. So we the Access BIC manage all of the deal flow into the syndicate that you're a member of, so the Boole Investment Syndicate. So I've got a good idea of the types of investments that you have invested in. But maybe just to kind of build on what Dennis is saying there, and to talk a little bit more about investing through a syndicate, what are the benefits of that, of deal flow coming in, and then being able to use kind of like-minded people to bounce some ideas off to discuss the opportunity with.
Yeah, thanks, Larry. Yes, I'm part of the Boole Syndicate here in Cork, and for about 10 years now. So we've looked at lots of deals across that time, and Larry and his team bring those to us. Some of the upsides of that is you get a good broad range of sectors. So the investments are across a range of sectors, and by the time the deals are coming to us, they've been reviewed fairly significantly. So you've got a lot of information, even in the first meeting for us. You've got a lot of information there. Some of the upsides of being part of a syndicate, and I also do some individual investing, so you can kind of compare. But with the syndicate, you've got some like-minded people around the table. So if there's a sector, you'll have people who are knowledgeable in tech, in med, in across the different sectors. Generally, you'll have a good range of people there. You get to know people over a period of time. So you can have offline discussions, you can chat about things, and it does help to build up your own knowledge and portfolio of then what might work, what may not work in the future. It kind of takes that feeling of being in this on your own away from the whole thing. You know, you have a sense of community, you have a sense of people that you can talk to, and I think that's a great benefit if you're, especially when you're approaching angel investing for the first time. I think that makes a big difference. The other aspect of it, when you have a syndicate, is you can have probably smaller ticket sizes than if you're going in on your own. So you can have investments 5K, generally 10K and upwards. So For example, in Boole, our investment overall, the investment will be 100k, maybe 200k in size. But at an individual level, it can be about 10, 20. And that, I think that's very helpful because it enables you to invest across, a large number as opposed to one or two companies.
Very good, Teresa. Yeah, thanks for that. So maybe Jerome, in terms of the kind of the move from a founder, and we're seeing that more and more in Ireland now as the kind of ecosystem kind of matures, and we're seeing a lot of founders come through good exits, and then they come back and they want to invest in the next phase. But that's a very different skill set to from being a founder to being a good investor. So can you talk to me a little bit about that transition and what the kind of natural tendency of a founder is versus what the tendency of an investor should be?
Yeah, definitely. It's there's a big difference between the founders that have gotten some exits and want to give back or pay it forward in some way, and those types will tend to be fairly passive investors. They want to encourage entrepreneurship. I know that this was very much my profile, especially early on. Encouraging entrepreneurship, you spot good projects or you spot good founders, you want to help out, and those will be more FFF type deals and rounds, very early stage capital to
Just
kickstart them.
again for our participants here, FFF, if you want to explain just a little bit about that.
Yes, sorry, friends, family, and fools, which is kind of your as a founder. This is one of the very first rounds you might do to gather some very early seed money. We're talking in total, an FFF round might be like 50 to maximum 100K. Otherwise, we're talking real pre-seed rounds. And for so that really contrasts from wanting to be an angel investor because you want to actively dedicate a portion of your income to this much more professionally, right? Which is something I got into that side later, especially as I wanted to scale myself. And this wasn't a matter of scaling the activity itself, but rather scaling the impact I wanted to have. Because as a founder, you have this drive, you see the problems, you want to solve them. And as you gain experience across multiple sectors, you see more and more problems and you see more and more potential ways to solve them, but you only have so much time. And this is where becoming an angel investor is a very efficient way of being able to scale your impact, because you're able to see and notice the high potential projects, the right solutions that just need the time invested into them, and provide capital, but also provide extremely important early stage advice, which is not something that the more passive pay it forward type angel investors would be providing. If anything, those can be actually kind of counterproductive, because founders listen to investors. They have this implicit there is, on the one hand, there is implicit trust that the investor might be more experienced than me as a founder, but also because the founder has given me capital, I feel this obligation to give back by listening to them more intently. And so it's extremely, extremely important that if as an angel investor you want to be active, that you remain active only in what you actually know, or otherwise highly contextualize your advice.
Yeah, I think that's a really key point because, these companies are at such an early stage and are so delicate. The wrong, they can maybe suffer one wrong move, but two wrong moves is going to be, could be detrimental to this company. So I think that's a really important point for sure. Dennis, we kind of spoke a little bit earlier, Georgie spoke a bit earlier about, cash is important into these companies, and it's often very much the kind of key focus when they're raising funding. We need to get the cash in because we need to pay wages at the end of the month, or we need to get this product to the market, etc. But it's not the only contribution that an angel investor makes. Can you talk to me a little bit about the other benefits of angel investors beyond cash?
Well, I think that, of course, investors overall, if you compare entrepreneur, founder, and investor is more like a passive role. So you just give some contribution, like cash contribution, and hope that something good will happen alongside down the road. And in this sense, yes, investors may become more proactive at some points, and especially when founders request some help or ask for some help. Yes, investors get involved, and good founders, they manage the investor network, and they try to get as much advice, as much support from the investor network as they can, because maybe one of the big mistake of a founder can be breaking communication with investors after getting this funds from them. And when the founder keeps investors involved, oftentimes investors help to find new markets, to find new investors, new suppliers, new expertise to help with financial model, with business strategy, whatever. Some investors even do it just for fun or just for free, because just because they can. Some investors do it in exchange for example, some increased share in the company or board position or whatever the agreement is. But I think that truly successful companies and truly successful entrepreneurs, they do engage and do collaborate with the investors network, and usually this network is really very strong, very diversified, with all kinds of expertise which can be extracted. And in this sense, I'm personally usually helping companies with financial modeling and building some kind of viable business plan, so that they can better understand where they are and how to get to at least some kind of break-even functioning of the company, how much it takes in terms of money, in terms of time, in terms of people, in terms of effort. So that, because being realistic is very important in business, and remaining a dreamer is usually, for too long, it's usually leads to bad results. So yes, that's the part of non-financial engagement or involvement. And for me, it is like maybe 30% of my portfolio really requires and requests such help, and I help them more or less.
Okay. So that's interesting. So there's, out of a portfolio of 15, maybe 30% that you're actively involved in beyond the investment. Okay, so you step in where it's useful and you step out otherwise. I think the other key point there is, and I think investors, shouldn't need to insist on this, but it can surprise me at times how poor companies are at communicating back to their investors after the investment, until the next investment is needed, and that's never a good thing, right? to only communicate when there's a need for new investment. It's to update and to be kind of honest in the updates and be kind of open with what the challenges are, because you will very often be able to find solutions within your network if you're open about the challenges that are hitting your startup at that point in time.
Yeah, will I just add to that? I think it's important.
Absolutely, yeah. Thank you.
Thanks. I just agreeing with what Dennis and Jerome are saying there, and really, I think one of the big things that investors bring are their network and others that they may connect with. I think Jerome's point is very good. Don't try to add advice where you don't have the knowledge or expertise yourself, and maybe people will over listen almost to investors. But a big thing is for startups or for founders is to tell investors what's going on. And maybe if they're not meeting milestones or something significant is happening and they're aware of it, to reach out for help, because generally investors can help them in terms of their knowledge, network, or otherwise. And to do that sooner and keep in touch is important.
Excellent. I might just say to there, Therese, as well, as specifically on female investors and I think it's in Ireland at least. Anyway, I think it's fair to say that it's very much a male-dominated area, angel investing. So from kind of your point of view and from what you've seen with angel investing, why is that, and what are the challenges for female investors, angel investors?
Female angel investors. It's an interesting question. And I suppose I started to think a bit about that myself, because when I looked the percentage, interestingly, fewer female angel investors, and then fewer into just investment into female founders. Probably in the overall ecosystem, maybe women tend to be financially more conservative in spending and investment. That's probably just at a very macro level. And then it's also looking towards what do you see? So maybe if you see other people doing it, you're more likely to continue and walk into it and say, this is something you can do. I think, first of all, maybe some people looking at angel investing initially, it can seem very daunting, very large, and like a huge commitment. Where I think if you break it down and say, look, we can make, some investments, it can be 5K, they can be 10K, we can build up a portfolio in that way. It makes it maybe more manageable and something that more people may reach into. Possibly it's that, Larry, possibly it just hasn't been there for so many women. Maybe they're too busy with other things. Could be as well. But I think as it progresses, maybe more women will reach into that space as well.
Yeah, I know, absolutely. I think even in the Bool, we're beginning to see a little bit of that change happen over the last while, but it's been slow for sure.
It is. Yeah.
Yeah. So look, we might just kind of wrap up, folks, with just one final thought on things, and it's for the potential angel investors on the call today. And Jerome, you might kick off on this. So in your successful investment to date, or your successful investments, or even your own companies that were successful, what were the kind of one or two key ingredients that you saw in those, or that you look for in your next investment?
This is question
Jerome, sorry, to Jerome, sorry.
Okay.
I'm sorry. What in terms of what we're looking for, it's very much and so I'm wearing two hats, by the way, because I'm wearing my own hat as an angel investor and also as partner at Seven Capital, which has also done syndicate type investments as well. The key thing as my personal investments is always going to be the team, because that's what makes or breaks the startup. Ultimately, whatever challenges are being thrown at the startup, there's a lot of it will be based on the resilience of the actual team, whether they can tackle that or not. And then comes the factor of, is it actually worth for the team to continue down a path that is not going to yield any either useful results or any sort of too big, require too big of an investment for them to actually find a solution. And that's that has to do with my own expertise. This is where my own expertise comes in, where I will be evaluating the startup based on whether or not technically it's feasible, technically it makes sense, it is solid, whether it's realistic. And the things I explicitly don't look for, I think might be more useful. So I don't try to figure out, is this a good product? Is this a product that is going to have great product market fit? Is this going to attract a lot of customers? Because these are the things I don't necessarily know, right? My background is in engineering, and so I know that as an engineer, I can evaluate very solidly the foundations of the products I'm investing into. I can evaluate the team. I can evaluate their technical capabilities. But I also know my own weaknesses, so I will explicitly not try to full scale evaluate the product, and that is not my role, right? This is why it's also very useful for the founders themselves not to get a bunch of investment from one person, but to diversify their own investors, because they get to diversify the experience of those investors and the value add that they can provide. This is especially present if they are part of an incubation acceleration program, where there might be lots of advisors that can intervene and maybe intervening themselves as angels as well. I will actually try to understand who else the startup is talking to outside of their team, as advisors, as investors. Do they have everything covered, right? So those are going to be the most impactful early on in the product lifecycle.
Okay, perfect, Jerome. Thanks, Trad. So that's coming out strong there is team, diversity of network, who the advisors are. Dennis, I saw a question come in there on the chat, and I might bring this.
I can actually add one last thing if you
Jerome, go ahead.
Because I enjoy the role of being an active investor, I will especially look for startups where I can add the most value. So if I have to choose between allocating a 10K ticket between two completely identical companies, except one of them I can mostly just provide capital and general advice, and the other one I can make fantastic introductions and potentially get them their next hire or co-founder or their first clients or things like that, it's always going to be the same.
Yeah. Okay. Makes total sense. Absolutely. Where you can turn the dial, as they say, for the startup that you're investing in. So Dennis, the question there that came in was around financials and how do you usually control financials in startups? Right. I guess as an investor, you can't really control the financials in a startup, but I guess the question is around the quality of the financials that they give to you. Do you trust the financials that come through from a startup, or what kind of due diligence are you doing on the financials that come through? So that's an area that you're particularly strong in.
Well, yes, thank you for the question, and I must say it's pretty easy to control financials because startups usually loss making, so it's not much you can control. But yeah, I'm trying to invest in startups which at least have some revenue. They don't usually have profits yet, but they at least have some revenue, and Usually the idea is to help them to understand how much more money they may need to actually to reach to become a business. And this is very important. And also, so the only part you can control is your own money, how much you invested, and how your ownership rights or your investment rights are protected within the company. Because sometimes this part is also very weak, and you don't have any guarantees that you will be remembered, at the exit stage that you invested something, or that it was properly documented and so on. So this part is important to control. In terms of financials, usually companies send financials, and investors accept what they send, because of course making audits and all this external validation is additional money, and nobody wants to put additional expenses on the company which is already struggling. So in this sense, it's not. I mean, it's not so important. So this question can be connected to a previous question: what we look at when picking companies to invest. And yes, we're looking at people. We are looking at people, and we are looking at ideas. And if it's idea which you just cannot ignore, which you cannot forget, and it's a person which you see that this person will succeed, and this true entrepreneur, and this entrepreneur may be like serial entrepreneur with several exits before, then you invest because it's just a probability game. The probability that this person will succeed is higher than some other person compared to him or her. So and again, related to another topic which you discussed, usually evaluation of startups is made at this stage, at late seed stage, which I invest in. It's based on costs, not on revenues or comparisons, but on costs, on expenses. So you just estimate how much it will take the team of like 3, 5, 10 super talented people to build something extraordinary, how long it will take, how much they will spend along the way, like 3 to 5 years. And this is the only way to evaluate the startup. And yes, usually you come to the number of like 10, 15, 12 million valuation, up to 20. And it's okay, it's normal. You take this risk. But yes, the downside of the story is that this sector or this area is very cash poor. Yes, you will not see any real cash flows for quite a long time. And you also should be prepared for that when you make such kind of investments, that it's not a dividend model, it's not interest on banking, deposits or whatever or bond. So it's something which you may exit in 5, 10 years if you're lucky, and not sooner than that. And along the way, it's mostly expenses. So this is like financial, from financial perspective, how it looks like.
Perfect. So Teresa, we'll finish up on with the last. Anything to add in terms of that, in terms of the investments that you've gone into? Anything in common with to watch out for, adding to Jerome talking about team and what Dennis has just said there?
Yes, I agree with what both are saying there, and particularly Dennis's last point there on time frame. I suppose in a lot of cases we will look at, I don't know, 3 to 5 years as a time frame, but I think 7 to 10 years can be much more realistic. And I think it's important at the beginning of the journey to be able to see, yeah, this is a long-term investment. I think if you're comfortable with that, it's a good space to be. If you're not, I'd be a bit more cautious about it. But I think having that long-term view is very important at an investor level. In terms of the investments, I'd fully agree with what both said in terms of the team being particularly important. Also with regard to the product and what they're doing, and that they believe in that. But importantly too, that they'll be willing to pivot. So the team will, if the particular product isn't going well or something isn't working out, that they can stand back. They're not overly attached to their plan, that they can stand back and pivot from that. I think that's also a characteristic that works well.
Absolutely. Okay.
So
Perfect, folks.
just
Look, we've covered a lot of ground there, so that was, I think, very useful to everybody. So Dennis, Teresa, and Jerome, thank you very much for jumping on and helping out today. If you want to pop in your contact details into the chat, if you're happy for people to connect
sure.
with you, then do so by all means. But really appreciate your help today, and especially Teresa at last minute. I know you stepped in very late today, so really appreciate that. And
Of course.
look forward to seeing you again, folks, in the future there again.
Thank you. Thanks a lot.
Perfect.
Thanks.
Okay, cheers, folks. So look, we're going to hop on here and just kind of wrap things up a little bit. Is that okay, Georgie? There, I've shared screen again. Is it?
Absolutely, that's perfect. Yeah,
I'm
super.
looking okay
So,
there. Perfect. So thanks again to our panel there. Questions, I think we're okay, Georgie. The last question that came in there was on the financials, which Dennis answered well there, I think. So we're going to just go to wrap up basically. So Georgie, do you want to take over here and give me a hand on the wrapping things up here?
let you take a breath. So
Yeah,
thanks so much
cheers.
for everyone's time and attention. I suppose we hope that there's a little more awareness of the role, the responsibility, the benefits, the fun that might be possible in angel investing, and the impact that you can have in an ecosystem that really does need the support and value it. And obviously that's why we've got such great attendance here today, because people really care. So we want to support that. I see lots of links. Teresa and Jerome have put their LinkedIn and their email into the chat. So these people who are on the ground investing as angels are very happy to help and support, as well as are we. You can reach out to myself and Larry and the team here at Access BIC. We are a little further away, but it's very close to our heart. So yeah, we will have another couple of workshops coming up the 23rd of October at the same time. So Ukrainian time, 3 o'clock till 5. We will be covering angel syndicates and angel networks. We'll be going a little bit deeper into setting up an angel syndicate and how you might do that. We'll be covering off some stories and the Pan-European Angel Network. And then following on from that, a month later, we will do a deeper dive into due diligence around investing, how you might make that investment, what that might look like in terms of convertible loan note, or equity stake. How do you decide on those things? We'll look at portfolio management if you're thinking of investing in multiple companies, and we'll look at some exits and successes. So hopefully you will be informed. There's no particular exact science to this, but we're going to do our best to help guide you and support you on your journey.
Absolutely, yeah. So today is very much the introduction. We're going to go a lot deeper in the next session. We're going to start talking about, we're going to get to see an actual pitch from a successful company that have managed to secure investment, just to give you an idea what that looks like. And then in November, then we're going to talk about the mechanics of actually making that investment. So we're kind of stepping you through from kind of start to finish here. So thanks for that, Georgie, for that. Just then, finally, there's lots of other really interesting things happening on this wider project. In particular, interest to the participants here who might be interested in looking at investing in some companies. We have what's called a demo day. So we've done several of these demo days. The companies that we're working with on this project have gone through various acceleration programs. And the end of that piece of work is a demo day where they get to demonstrate their startup and their technology and their team and their traction in the market to an audience of investors. You as potential investors are more than welcome to come along. Our next one's actually tomorrow. So from 2 o'clock until 4 o'clock Central European time tomorrow. We will share in the chat here now the link to register for that. So you'll get to see 20 startups tomorrow pitch for investment. So that could be of a lot of interest. Perfect. So look, there's nothing more for me to do here than thank you for participating. Thank you to our panel members again, to Asir for stepping in. It was unfortunate that Yuri wasn't able to join us for his piece on the Ukrainian ecosystem, but we will share his slides and hopefully he'll be able to join us in one of the later workshops and go through that. It's a really important piece, particularly for Ukrainian business angels, to describe exactly what the Ukrainian ecosystem is looking like at the moment, given all of the huge challenges that are happening at the moment. So we will say thank you and wish you the best until we hopefully see you all again in the very near future. So thanks, folks.